Welcome back to the channel. In this week's video we're going to look at a fund that's gone up each of the last 5 12-month periods. So I'm going to give a bit of an introduction and then reveal the fund. So for accumulating wealth, if you're buying every month, then a temporary decline can be a good thing, as you can buy more units of your favourite fund. But if you're retired, that's not the case. You're not buying any more and you don't want any declines. You can begin to doubt a fund that was once popular and well respected, and many people are doubting Fund Smith at the moment and are realizing that Terry Smith is kind of this one club golfer where the club is just quality growth stocks, but he's buying them at any price. So you need to be on the lookout for new things to fill different roles in your portfolio. So defensive funds have been around for a long time. I've done a video on Ray Dalio's all-weather portfolio, which has volatility adjusted position sizing to try to give consistent returns under a variety of different economic conditions. And it has gold, commodities, S&P 500, long-term and intermediate bonds within his portfolio, and it's done pretty well. It holds a variety of ETFs, but it still has drawdowns. So I've done another video looking at some defensive investment trusts, and of those the one with the best capital trading record is Capital Gearing Trust. It holds index-linked bonds, it holds gold rather than other commodities, which is a bit of a shame. It holds some value stocks, some property and infrastructure stocks, and it holds preference shares and corporate debt. And what it does is it rotates weightings according to where it thinks the most stable returns might exist. And it generally does pretty well. The commentaries it gives out are really interesting. It's well worth researching that fund, but ultimately we can do better. So typically during economic turmoil, it's felt that bonds will do well because interest rates will be cut to boost economic activity, making existing bonds with higher interest rates more valuable than the currently issued bonds on a lower interest rate. But if we look at this Vanguard bond fund, we can see it's lost nearly 20% in the last 5 years, and the performance has been truly horrible, and it's not really filled its role as being potentially negatively correlated with equities during a market downturn. So what's worked well in the past simply cannot be relied upon. So be very wary of a 60% equities, 40% bonds portfolio. With so much debt out there in the world, it's difficult to see a return to high interest rates. It just won't work. But high inflation is possible, as that will erode the value of debt. When you're back testing and seeing how well something might fit in your portfolio, use Monte Carlo analysis, which randomizes the returns around a central number rather than using past returns, because I think the future will be very different. So we need to look for a new type of fund. To get positive returns each calendar year, you need a fund with a very wide remit. Something can literally pivot in no time at all and suddenly go from being long to being short, to using both buy and sell options in the market. So one fund that can do that is the investment trust BH Macro. And it's kind of a black box. No one really knows what it does. It does well when markets decline, but not so well in bull markets. And it has high fees, including a performance fee, and it can trade at a premium to net asset value. So the very time when you think, oh yeah, this is a good idea, I'll buy BH Macro, it's actually trading at a premium to what it really should. So you can get caught out with it. So what I've selected is Man GLG Alpha Select Alternative. And this can go long, can go short. It trades primarily in UK equity markets, and it aims to have a market neutral position. So it's got both long and short positions simultaneously. So it's got low correlation to equity markets, and it typically just holds large cap stocks. It diversifies across sectors and across different investment ideas. And it aims to deliver absolute returns in any market condition on a positive basis over a rolling 12-month time frame. The fund size is 1.7 billion, and that's large enough to fund a decent team of analysts and to buy in substantial macroeconomic data. So although people are saying, well, you can't time the markets, I think if you've got enough money behind you, then you can give it a good shot. So the performance of the fund, we can see here, it's down the bottom here. It's the only one that's got positive returns across all the 5 12-month periods. All the others, you can't always see it very clearly. They've had at least 1 year of negative returns. And the top performing one in the last 12 months is this Lion Trust European Strategic Equity. So this one can go short European equities, which it has done recently, although the prior performance has not been very good, and there's a risk here of mean reversion. If the strategy doesn't work across a series of different economic conditions, then arguably it's not really a long-term hold for you. And so to quote the streets, and I do like my rappers, weak become heroes. So it's weak here, then it's a hero, probably going back to being weak again. Now, if we look at the Sharpe ratio, that is returns adjusted for risk. So it's the risk-based unit of return. And Man GLG, it doesn't come top. However, the ones that do beat it don't have as high a 5-year growth record. So arguably, although the Sharpe ratio is higher, these funds don't quite deliver on a returns basis. Also, this TM Telworth, I'm not sure this is right. It seems to be a very small fund. And so the ongoing charges fee, it is the highest of all these. The fund does pay a performance bonus, which is unfortunate, but if you want superior returns, you generally have to pay the fund manager a lot of money, unfortunately. And then for here, we've got the very rare occurrence of a Baillie Gifford fund with positive returns over the last 12 months. So my favorite quote from the film Good Will Hunting is, "How'd you like them apples?" Which Matt Damon says when he gets Minnie Driver's phone number. So this is, it's the residual return, which is really the alpha of this alpha fund. And you can see that, yeah, a bit of a wobble at the start while they're getting things going, but since then, very consistent. It's just a lovely, smooth performance curve there. So yeah, what's not to like amongst that? So for the summary, the fund, it's slow and steady. There's numerous funds that outperform it, but none have such low volatility. So you can hold this fund during poor market conditions and really sleep well at night. It might be better if it had a global remit rather than just the UK. A fund does a lot of hedging, and hedging is all about locking in a profit and not just locking in one side of the equation. So it's not just about locking in revenues, but then ignoring the costs. Now, if you're doing this hedging properly, then I suppose the returns will be quite low because you're pretty much guaranteeing a return. And if you're doing that, then those returns probably will be low. But the Man GLG fund is a superb example of what it does. And finally, just keep learning. So if you like the video, hit the like button, subscribe, and I'll see you next week.